Credit cards can be one of the most powerful tools in your financial life, or one of the most dangerous. It all depends on how you use them. Used wisely, credit cards help you build your credit history, protect your purchases, and even reward you with points or cashback. Used poorly, they can lead to years of debt, high interest payments, and stress that feels impossible to escape. So today, let's talk about smart habits that help you avoid credit card debt, and use them to your advantage instead. By the end of this video, you'll understand how to make credit cards work for you, not against you. Let's start with one of the most important principles. Always pay your balance in full every single month. This is the golden rule of credit card use. When you pay the full balance before the due date, you completely avoid paying interest. Credit card interest rates are often 20% or more. That means if you carry a balance, your debt can grow fast. So think of paying in full as a way of keeping your financial freedom intact. Now, here's the next smart habit: never spend more than you can afford. It sounds obvious, but it's the easiest mistake to make. Credit cards make spending effortless. You swipe, you tap, and it feels like free money, but it's not. A smart approach is to treat your credit card like a debit card. If you don't have the cash in your account today, don't spend it. That way, when the bill arrives, you can pay it in full with no stress. Another habit that makes a big difference is keeping your credit utilization low. Your utilization rate is the percentage of your available credit that you're using. For example, if you have a credit limit of $5,000 and you spend $1,000, your utilization is 20%. Keeping this number under 30% is good. Keeping it under 10% is even better. It shows lenders that you're responsible with credit, which can help boost your credit score over time. Next, set up automatic payments. Missing a single payment can drop your credit score by dozens of points, and it can also cost you late fees. Automation removes the risk of forgetting. Set up automatic payments for at least the minimum balance so you never miss a due date. Then, pay the rest manually before the deadline. This small step protects your credit and keeps your finances on track. Another smart move is to use your rewards wisely. Credit card rewards can be amazing: cashback, points, miles, but only if you're not paying interest. If you carry a balance, those rewards lose their value quickly. Think of it like this: if you earn 1% cashback but pay 20% interest, you're losing 19%. Use rewards for things you already plan to buy, not as an excuse to spend more. Checking your statements regularly is another essential habit. Fraud, double charges, or billing errors can happen to anyone. Make it a routine to review your statements every month. If something doesn't look right, report it immediately. Credit card companies often offer strong fraud protection, but it's your job to catch problems early. Let's talk about one of the biggest traps: minimum payments. Paying only the minimum might sound like an easy option, but it's one of the fastest ways to fall into debt. Here's why. Most of your minimum payment goes toward interest, not your actual balance. If you owe $2,000 at 20% interest and pay just the minimum, it could take you years to pay it off, and you'll end up paying much more than you borrowed. Always pay more than the minimum, and if you can, pay the full amount. Another important habit is to keep your old credit accounts open, especially if they have no annual fee. Here's why. The length of your credit history affects your credit score. Older accounts show lenders that you have long-term experience managing credit responsibly. Closing them too soon can shorten your credit history and reduce your available credit limit, both of which can lower your score. Now, let's talk about applying for new credit cards. It's tempting to chase every new reward offer you see, but each application creates a hard inquiry on your credit report, which can temporarily lower your score. If you apply for too many cards in a short time, it can also make lenders see you as a higher-risk borrower. Only apply for new credit when it truly benefits your financial goals, like a card with rewards that match your spending habits, or one that helps you build credit responsibly. It's also critical to understand your card's interest rate and fees. Many people don't even know what their APR is, the annual percentage rate that determines how much interest they'll pay on balances they carry. Knowing your APR helps you make informed decisions. Also pay attention to annual fees, late fees, and foreign transaction fees. Those small costs can add up quickly. Let's pause for a moment and talk about mindset. Having a credit card isn't a sign of wealth or financial success. It's a tool. And like any tool, it can be used to build something strong or to cause damage. The goal is not to avoid credit altogether. The goal is to build good habits that make credit cards work in your favor. Here's another key point. Credit cards can protect you in ways cash or debit cards can't. When you buy something with a credit card and the item arrives damaged, or doesn't arrive at all, you can dispute the charge. That's a level of protection that debit cards usually don't provide. Plus, credit cards can come with travel insurance, extended warranties, and fraud protection, benefits that are valuable if used correctly. If you travel frequently, using a credit card can also make things easier. Some cards waive foreign transaction fees or offer points on travel expenses. But always check the fine print before using your card abroad, and make sure to pay the balance in full once you return. Now let's talk about one of the biggest myths, that carrying a small balance helps your credit score. That's completely false. Your score doesn't improve by paying interest. It improves when you show consistent, on-time payments and responsible use. Carrying a balance only costs you money. Another thing to remember is that credit cards aren't meant to replace your emergency fund. If you face an unexpected expense, like a medical bill or car repair, relying on your credit card without a repayment plan can push you into debt. Instead, focus on building an emergency fund of at least 3 to 6 months of living expenses. That way, your credit card remains a tool of convenience, not survival. Let's move on to a few additional smart habits that often go overlooked. 1. Check your credit report at least once a year. In many countries, you can get a free report from each major credit bureau. Review it for errors or accounts you don't recognize. Correcting mistakes early helps maintain your credit score. 2. Link your credit card alerts to your phone. Many banks allow you to receive notifications for every purchase. This helps you catch fraudulent charges instantly and keeps your spending visible in real time. 3. Plan your large purchases strategically. If you need to make a big purchase, time it right, preferably right after your billing cycle closes. That gives you the maximum number of days before the payment is due, interest-free, as long as you pay in full by the due date. Now, let's talk about mindset again, because financial habits are not just about numbers, they're about psychology. When you swipe a card, you don't feel the same pain of payment as when you hand over cash. That's why people often spend more with credit than with cash. To combat this, review your transactions weekly. Seeing where your money goes helps you stay aware and in control. And remember, your credit card doesn't define your financial success, your discipline does. Having a high credit limit or fancy rewards card doesn't make you financially strong. What matters is paying on time, spending mindfully, and staying out of high-interest debt. Now let's recap the key habits we've discussed today. Pay your balance in full every month. Spend only what you can afford. Keep your credit utilization low. Automate your payments. Use rewards wisely. Monitor your statements. Avoid the minimum payment trap. Keep old accounts open. Be cautious when applying for new cards. Know your rates and fees. And above all, stay intentional with your spending. These habits don't just protect you from debt, they help you build long-term financial health. A good credit history can help you qualify for lower interest rates on loans, better mortgage terms, and even cheaper insurance premiums. In other words, managing your credit cards well doesn't just save you money now, it can save you thousands in the future. Before we wrap up, here's one final piece of advice. Don't let credit cards control you. You're the one in charge. When you use them strategically, they become an asset. When you use them carelessly, they become a liability. The difference lies in your habits. If you found this video helpful, make sure to like, subscribe, and hit the notification bell. That way, you won't miss any of our future videos on budgeting, saving, and investing. And if you know someone who struggles with credit card debt, share this video. It might help them take the first step toward financial freedom. Thank you for watching Smart Money 101, where we make personal finance simple, practical, and stress-free. Until next time, stay smart with your money and stay in control of your financial future.